Financial fraud can severely damage a company's reputation, finances, and stability. Whether it's embezzlement, falsified financial statements, or payroll fraud, businesses must remain vigilant to detect and prevent such activities. Recognizing red flags early can save a company from significant losses and legal trouble. Here are 10 key ways to identify financial fraud in a company. 1. Unusual financial discrepancies. One of the biggest indicators of fraud is inconsistent financial records. Watch for unexplained variances in revenue, expenses, or cash flow. If financial statements don't align with expected performance, conduct a deeper review to identify potential manipulation. 2. Excessive rounding or repetitive numbers. Fraudulent transactions often involve numbers that are too precise or follow predictable patterns. If financial figures consistently end in zeros or repeat in multiple accounts, it may indicate that someone is fabricating data. Auditors often use forensic accounting techniques to detect these irregularities. 3. Increased vendor payments without clear justification. Fraudsters may create fake vendors or inflate payments to existing suppliers. Review vendor lists regularly and check for duplicate or unfamiliar names. Cross-check invoices with delivery records to ensure all payments are legitimate. 4. Employees who are overly protective of financial data. If an employee refuses to share financial records, avoids audits, or insists on handling transactions alone, it could be a red flag. Financial transparency is crucial, and no single person should have complete control over accounting processes. Implement a checks and balances system to prevent fraud. 5. Sudden lifestyle changes of key employees. An employee living beyond their means, such as purchasing luxury items or making extravagant travel plans without an apparent increase in salary, may be involved in financial fraud. Monitor employees handling sensitive financial data for unusual behavior. 6. Fake or altered invoices. Fraudsters may submit invoices for goods or services that were never provided. Check for duplicate invoices, inflated costs, or missing details. Verify invoices against company records and ensure approvals follow company policies. 7. Manipulated financial reports. Companies committing fraud often adjust their earnings to mislead investors or avoid regulatory scrutiny. Look for inconsistencies in financial reports, such as sudden spikes in revenue without matching increases in sales or cash flow. If profits seem too good to be true, they probably are. 8. Unauthorized bank transactions. Regularly review bank statements to detect unusual withdrawals, transfers, or unauthorized transactions. Even small, frequent transfers to unfamiliar accounts could indicate fraud. Set up automated alerts for suspicious banking activity. 9. Weak internal controls. A lack of internal controls makes fraud easier to commit. If a company doesn't separate financial duties, such as having one person approve and process payments, it increases the risk of fraudulent activities. Regularly review and strengthen financial policies to ensure proper oversight. 10. Anonymous tips or whistleblower reports. Many financial fraud cases are exposed through employee tips. Companies should establish anonymous reporting channels, such as fraud hotlines, where employees can report suspicious activities without fear of retaliation. Studies show that businesses with whistleblower programs detect fraud more quickly than those without. Financial fraud can be devastating for businesses, but spotting warning signs early can prevent serious damage. By monitoring financial records, enforcing internal controls, and encouraging transparency, companies can reduce the risk of fraud. Regular audits and employee awareness programs are essential tools in maintaining financial integrity and protecting a company's assets.